Hi, in this video, we are going to learn about inflation. To learn about inflation, this quote is sufficient. Americans are getting stronger. 20 years ago, it took two people to carry $10 worth of groceries. Today, give a 5-year-old, he can do it. It's basically saying 20 years ago, you could buy a lot and it needed two people to carry it. But now you only get maybe a few fruits or vegetables that even a 5-year-old can carry it. So basically, the buying power has reduced for the same amount of money. And things get expensive over time. We've all heard people say I used to go for a movie in $2, $3, and now we know it takes $10, $20, right? Things get expensive over time. That factor of things getting expensive is inflation. So between 1915 and 1920, it was so bad that cost of living almost in that 5-year period nearly doubled. So almost 9 to 10% every year inflation was increasing. And so history tells us that there are times where the consumer price index or inflation increases, things get expensive, cost of living gets um, very expensive. And if we look at 100 years, what we can see is that we can expect, at least going into the future, that every year 3.2 to 3.5% inflation is expected. So what does that mean for us? So when I say I made 2% more this year, or I got a raise for 2% this year, and inflation increased by 4%, that means I actually, overall, my take home money is down 2% because it's 4 minus 2. It's 2 minus 4, so minus 2%. So if we know this powerful concept of inflation, then we would actually be able to calculate accurately what is our take home money actually, how much is our wealth actually increasing, so that we can buy the same set of goods and services into the future without having to worry about losing value, right? So then the question for us is, now that we understand a little bit about inflation, where which instrument, which financial instrument, which investments is better? Is it stocks that are better, or is it bonds that are better to hedge against inflation? My understanding reading this chapter is that Benjamin Graham feels that it's leaning towards stock. I didn't get a definite answer, but it's saying it's leaning towards stock, and he's saying mostly, and there's no definite answer given. So he's always advising to have a mixture of stocks and bonds. And there are some charts that we will show in this video, which will tell us why. But as a rule of thumb, 75-25% stock is to bond, or a 50-50 stock bond is something that he's consistently over the last 3 chapters advising us. So, and then the key piece of rebalancing is another thing that he has shared, which is if certain times bond do really well or stocks do really well, you come back to your balance so that you don't get too aggressive in investments which can fall as aggressively as well, and vice versa. So you protect the downside. The other learning was 8% is considered to be adequate return. Anything beyond that is way too good. So this includes inflation. We saw 3%. It includes growth of 3 to 4%, and dividends based on like the company 1 to 3%. So at least 8% is what we can expect from common stock of really high quality blue chip companies. We will also what I've also seen is that stocks, they do really well in times when there is moderate inflation, but when there is either too high of an inflation or poor or low inflation, stocks perform really erratically, especially during poor inflation. Um, the stocks seem to perform really badly. And during high inflation, the stocks are erratic, meaning they can go high, they can go low. So there's like a lot of variance. But if it's moderate, constant inflation, then stock tentatively go higher. There are two instruments: real estate investments and treasury protected investments that are available today, which are practical. Um, REITs and TIPS, which can hedge against inflation in a pretty good way. If we look at this graph, we can clearly see that 1913 to 1919, 10%, right? Every that 5-year period was growing. Inflation was crazy. We also saw negative inflation 1930, 1939, and after that it has been 5%, 2%, 7%, and recently it's around 2 to 3%. And so the long-term projection based on the average of all of this is 3.22%, which we alluded to earlier. The other key factor to keep in mind is how much of these earnings the companies are giving us is based on overall profit that they are getting, is based on like overall debt that they are incurring. So looking at ratio of corporate debt and earnings compared to percentage of GDP, percentage of their earnings is a good indicator of finding out like, are things overpriced? Are the companies really paying money off by borrowing a lot of money? So that's a pretty good indicator. This is another chart which shows us like debt as percentage of GDP, and it's constantly just increasing. And here's the chart which is also important to look at, which is the savings rate of the United States has been constantly decreasing over time. And that's an important factor of how resilient the economy is and the people participating in the economy. This was a chart which clearly proves that when there is negative inflation or prices are decreasing, stock markets actually do really poorly consistently. But when there is really high inflation, stock markets are all over the place. Either they are returning high or returning negative. But when there is neutral or moderate inflation, stock generally tend to be performing higher. And these are the two low-cost funds that I was able to find: Vanguard Real Estate Index Fund and Vanguard Inflation Protection Securities Fund. These two are good for inflation hedging. If you're purely inflation hedging, then they could help in a pretty big way. Do remember that some of these gains, especially in treasury protected funds, are taxable. So that means that if you do buy them and the price goes up, there may be a lot of tax things that you'd have to look into. So do your own research here. Thanks.